My name is Gregor Bilbosian. I'm doing Bachelor's of Information System. I'm on my last semester. And after doing this subject, to be honest, I started looking for doing the master's in quantitative finance. As my major was usually I did data analysis, and I did a role in data science. So now, after doing this subject, I can see that I'm interested in doing the Masters of Data Science in Quantitative Finance. Uh, so let's deep dive in the company and the company's where the company heading to and the company's perspective after analyzing many things on Delta. By the way, I did first I worked on balance sheet, income statement, and then I worked on the financial statement of the company of Delta. Then I did M and R cash, M and R script, and M and R combine of Pioneer equation, and I'm gonna discuss that further later in the coming slides. So as you see, we do have the delta cash flow. After just analyzing it and just doing some statistics and doing the graph. So what we can understand from this graph that the company was successful from the operational side, and it started peaking till 2021. 2021 was the peak of the cash flow from operations, and then it started declining. So that means the company's operation after the 2021 was affected by many external circumstances. And also we can talk here about the cash flow from financing, so which was going down at the beginning of 2019, and it was declining till 2021. And we can see after the operational started declining, the financial cash flow it started increasing, and that means here the company started just trying to find more investors and started asking for more maybe debt and that kind of stuff. So in regards the cash flow uh, from investment, so we can see it was a kind of stable in the last 3 years, and that means the company's goodwill and long-term assets are stable. So yep. And we can see that the net cash flow is stable of the company. That means the company is doing well and everything is okay. And if we can jump in now on the parts which I worked in is the equation of uh, uh, Pioneer Limited to Delta Limited Company. So we can see when the Pioneer offered a cash equation and just bought the company by providing cash, we can see that the share price of Pioneer after the equation was increased, like, and maybe it's tripled, but the number of the share outstanding remained the same for Pioneer as it stayed 25,000 shares. Also, Pioneer tried to the script equation. On the script equation, we can see that the company here share price was a bit increased, which was a little bit, and also we can see that the shares just jumped from 20,000, 25,000 to 35,000 shares, outstanding shares of Pioneer, and this was on the script equation. The assets also was sitting it's something on um, uh, 1,900,000. That was the total assets after the equation. We can talk here also about the combined equation. So we can see that the share price was increased a bit more than the previous equation, which was the script, because here Pioneer just offered cash plus shares in this situation. So we can see that Pioneer share prices has increased more than the previous method, as it jumped to $32 sitting there, but the outstanding shares are remained the same as 35,000 shares.
Hello, I'm Will, and I'll be giving a breakdown on Delta Limited's capital budgeting for a new machinery investment and provide risk and return analysis for some of Delta's investments. Delta Limited is planning an investment which involves the purchase of new machinery, which costs approximately $150,000, fully depreciated over 5 years. The cumulative free cash flows and cumulative discounted free cash flows graph shows the distribution of Delta Limited's expected free cash flows with and without the time value of money accounted for over 5 years. The new machinery has a salvage value of $30,000 at the end of year 5, and Delta Limited expects to receive an average net income of $7,000 across 5 years. The project also involves a weighted average cost of capital of 15%. Let's begin with our objective measures for this investment, starting with the net present value of Delta Limited's investment, which is $41,837.63. And since the calculated net present value is greater than zero, this investment creates additional value for Delta Limited. As value is being created with the net present value being positive, the profitability index must be greater than 1, as the investment generates profit for Delta Limited, and thus the profitability index for this investment is 4.59. Furthermore, since the net present value is greater than zero, the expected return on the project is higher than Delta Limited's cost of capital, and thus the internal rate of return must be greater than the weighted average cost of capital, and thus the internal rate of return is 24.89%. However, the internal rate of return ignores the time value of money and thus overstates the potential profitability of the project, meaning a modified internal rate of return is required in order to gain a more realistic assumption about the reinvestment rate. Yet again, as the net present value is greater than zero, the modified internal rate of return must be greater than the weighted average cost of capital. Therefore, the modified internal rate of return is 20.8%. Moving on to the subjective measures. The payback period for this investment is 3 years. However, as the payback period doesn't take into account the time value of money, the more realistic and longer value for the payback period is the discounted payback period, which is 3.95 years. Moreover, the investment has an accounting rate of return of 7.78%. We need to compare this value to our company's required rate of return for investments. If the value is higher than the required rate of return, we should accept this investment. However, if it is lower than the required rate of return, we should reject this investment. And if it is equal to the required rate of return, we should be indifferent and research further into this investment. It should be noted, however, that the accounting rate of return does not take into account the time value of money. Thus, it doesn't consider that money received in the future is worth less than money received today due to factors such as inflation and the opportunity cost of not having that money available to invest elsewhere. Let's now have a look at the risk and return analysis of Delta Limited's share, a potential investment, and an investor portfolio. The graph provided details Delta Limited's share returns from 2016 to 2019. As Delta Limited's share involves a sample of data, it is represented by the sample marker in later graphs. Furthermore, this scatter plot shows the probability and return of an investment dependent upon the state of the economy. As this potential investment involves probability, it is represented by the probability marker in later graphs. This pie chart shows the investment portfolio of two shares held by an investor and clearly shows their respective weights. 75% held by share A and 25% held by share B. This investment portfolio is represented by the portfolio marker in later graphs. Now I'll go through the risk and return graphs as well as the coefficient of variance and Sharpe ratio graphs, which can give us a better idea of which investments have the best risk and return balance. Overall, visually, from the risk and return graphs, we can see that Delta Limited share has a good balance between risk and return comparatively. The potential investment is low risk, but also low return. And the investment portfolio is very risky, but also has very high returns. The coefficient of variance is used to measure the relative volatility of an investment, while Sharpe ratios are used to measure the risk-adjusted return of an investment. As such, Delta Limited share is the best investment as it has the lowest coefficient of variation and the highest Sharpe ratio. The second best investment is the investor's portfolio, as it has the second lowest coefficient of variation and the second highest Sharpe ratio. The worst investment is the potential investment, as it has the highest coefficient of variation and the lowest Sharpe ratio.
Hello everyone, my name is Keith Bamberlin, and today I'll be presenting some of the parts that I worked with within the group project. These parts included the ratio section, time value of money, as well as risk management. With my group, we were able to successfully complete the tasks in order to visualize our findings within this presentation. As you can see in this slide, financial ratios refers to taking numbers from a business financial statement and dividing it by another number. This will result in a ratio that can be used to compare businesses to evaluate further investment opportunities. For Company 3, I have created a ratio analysis with the data provided to further express the relationship among the selected items of financial statement data. I have analyzed 5 different ratios, including liquidity, profitability, financial leverage, asset turnover, and market value measures. Current ratios refer to how many times a business can cover liabilities without having to sell any inventory. The line graph being visualized demonstrates the drop in current ratio going from 1.25 times in 2019 to 0.77 times in 2022. This means that the business is decreasing in the number of times it can cover itself. Profit margin refers to the measure of business's profitability. The line graph showcased shows the data between 2019 and 2022 regarding the business profit margins. In 2021, the profit margin hit its peak at 15.75%, whereas the lowest profit margin experienced by the business is 3.50% during 2019. In this slide, we're explaining debt to equity ratio, which refers to the business's total debt in comparison to the original amount invested by the owners as well as their own retained earnings. The clustered bar graph accurately visualizes the debt to equity ratio for the business. It is made evident in 2019 it yielded the highest results at 3.17 times, whereas the lowest is in 2022, coming in at 2.46 times. Day sales in inventory refers to the average time in days that a business takes to turn inventory into sales. In the line graph above, it showcases the average amount of days taken. In 2020, it was 123.19 days, which was the longest time to turn inventory into sales, which can hinder performance. However, it improved significantly in 2022, coming in at 54.75 days, which is a massive improvement. In this graph, price-earnings ratio is the business share price to the business's earnings per share. This ratio is utilized to figure out if a business is being overvalued or undervalued. A clustered bar graph is utilized in order to visualize this data, so it can identify the different types of ratios. The highest data achieved was 10 times in 2019 and dropped gradually, with the lowest being 5.83 times. For this section of the presentation, I'll be talking about 3 of the most relevant examples of each slide regarding time value of money, as there are a fair amount of questions within this section. As seen as CIFV, if the effective annual interest rate is 10% for 6 years for $50,000, the future value of this investment will increase. which can be seen here. In addition, CI-CI wants us to calculate the effective annual interest. If Jennifer paid $26,000 to her friend for 4 years after borrowing $20,000, this means that she paid the effective annual interest rate of 6.78%. For FV, we needed to calculate the future value of George's cash flows at the end of year 3. If the effective annual interest rate is 5%, after receiving $26,000 per year for the next 3 years means the future value will be $81,965 at the end of year 3. In the next slide, for question FVOA-N, we had to figure out how long it takes to accumulate the future value of $20,000. If the annual effective interest rate is 8% when depositing $4,300 at the end of each year, it would take 4.11 years to accumulate $200,000 for its future value. Furthermore, PVOA-PV is looking to calculate the present value today of George's cash flows. If the effective annual interest rate is 12% when receiving a study award of excellence at $33,000 per year for the next 3 years, the present value of cash flows will be $79,263.43. For PVOA-N, we are meant to calculate how long it takes to repay the loan. If the annual effective interest rate is 5% after a loan of $110,000, the annual installments would be $11,000 at the end of each year. This means that it would take 14.21 years to repay the loan in full. In this slide, we will be talking about risk management aspect of the assignment, which refers to the process of identifying, controlling, and eliminating aspects that a business may experience. For risk management long, Delta Limited goes on a long forward contract with an exercise price of $700 per ounce for only 5,000 ounces, only to be exercised in 6 months. In the scatter plot, it significantly demonstrates that if the market gold price after 6 months is $900 per ounce, they would make a gain of $20,000. However, if the market gold price after 6 months is $400 per ounce, they would have to make a loss of $30,000. However, for risk management short, Delta Limited goes in a short forward contract with an exercise price of $700 per ounce for 5,000 ounces, only to be exercised in 6 months. This scatter plot, it visualizes that if the gold price after 6 months is $900 per ounce, they would make a loss of $20,000. Whereas if the gold price after 6 months is 400 ounce, they would make a significant gain of $30,000.
Hey there, I'm Dominic, and today I'll be presenting and analysing the Delta Company's income statements and balance sheets, and exploring the percentage change year on year, as well as running you through the company's vertical analysis and its horizontal analysis. After that, I'll explore a few different outsourcing options and discuss whether or not they'll be viable for the company. Okay, let's begin. So first off here, we'll be looking at the percentage change year on year for the balance and income statements. Analysis using the percentage change year on year is rather effective, as it provides an easy to follow snapshot into how certain accounts are performing compared to the year prior. However, this has some shortfalls that will be explored in a bit. Now from a first glance here, we can see a major increase in revenue in the first year, followed by a smaller but still significant increase in 2021, before failing to continue the trend and declining in 2022. Now looking further into the accounts, an increase in 2022 of cost of goods sold caused this trend to fail to continue. However, increases in 2021 in the EBIT at a higher proportion than gross profit means eventually the economic growth will slow down. If dramatic growth is desired like seen in the first year, the ratio of cost of goods sold to sales needs to be brought down. Here we have the company's horizontal analysis, which while similar to its percentage change year on year, achieves something slightly different. With horizontal analysis, a base year is used to analyze the accounts, and thus long-term trends are identified more easily. It makes it easier to see how accounts in the long term are changing at a glance. Remember before when I said percentage change analysis has some shortfalls? This is why. as all the percentages are based on previous years, so it's harder for investors to analyze trends into the company. So here in the horizontal analysis graph, we can see the short-term and long-term asset and liabilities accounts of the balance sheet. Using 2019 as a base year, we can see that the long-term liabilities are dropping pretty uniformly, so the company is meeting its long-term debt obligations. However, liabilities in the short term in 2020 and 2021 increased proportionally quite a bit higher than the current asset account, leading to a higher debt ratio and could cause potential concern to investors. However, we can see that this was corrected in the year 2022, with a substantial increase in the long-term asset account, offsetting the increase in the current liabilities account. Here we have the company's vertical analysis, which provides useful insight into the proportional makeup of various accounts. Analyzing like this makes it easier to understand the makeup of each individual accounts and provides visualization to ratios of account makeups. For example, we can see here the percentages of the gross profit compared to sales expressing in visual form the cost of goods sold ratio. As such, we can deduce that reduction in prices of cost of goods sold increase net income and gross profit, as expressed by these graphs in 2020 and 2021, with increases being realized as the ratio of cost of goods sold to sales is lower. Now I'll discuss whether or not it would be the correct decision for our company to outsource. This first scenario involves outsourcing or insourcing work. When variable unit cost is evaluated, it allows us to calculate break-even point, which in this case is $400,000, to turn a profit. And having demand for $450,000, the rational decision would be to outsource. Since we have now chosen to outsource, we must now pick what country to outsource from. We are given these risk factor criteria. When calculating who has the least risk factors, Colombia comes up victorious and meets the selection criteria. Now we must choose a company to outsource to. With all the different options and using a weighted arithmetic mean to account for the different weighting applied to the different factors, Pioneer Limited would be the smartest option to outsource to. Overall, if we are looking at all the data presented to us throughout this presentation, we can see whilst the company experienced rapid economic growth through 2019 to 2022, analysis of the year-on-year percentage change and vertical analysis, in turn with analysis of Keith's ratios, the company will begin to experience economic downturn into the future. However, various changes expressed and recommended throughout this presentation can be made to slow down or reverse the decline that the company is experiencing.